Since I stand between you and Paul Jenkins, I will be as brief as I can, but since this is our inaugural lecture in what we hope becomes a continuation, I thought I'd take a minute, first of all, to welcome all of you, to thank all of you, and to recognize the several members of the diplomatic community, the official Government of Canada community, and the academic community who have taken the time to join us this evening. CIGI was created about 11 years ago with a foundational grant from Jim Balsillie, the then co-CEO of Research in Motion, the BlackBerry people, and the federal government. And since then, we have also received a very substantive level of support from the province of Ontario. And CIGI was created with the express mission of identifying gaps in global governance, and then using research to move the agenda forward. So we're more than an academic institution, and we're not an advocacy institution. We live in a world in which we have too many institutions and too few at the same time. And CIGI's job, along with our fellow institutions around the world, is to create the esprit de corps globally and in Canada to investigate these issues and then move the agenda forward when and where we can. Nowhere is this more evident than in the predicament we find ourselves, so many of us around the world, economically. Markets were, and policy structures were too interlocked at one level and not interlocked enough at another. That has led to a series of repercussions where it's no longer possible to call this a financial crisis. It goes much beyond that. But fundamentally, its roots did lie in a series of complicated finance issues. And who better than Paul Jenkins to help us think them through and have the discussion with you on what that might mean globally and for Canada. Paul Jenkins is a career central banker. Between 2003 and 2010, he was the senior deputy governor at the Bank of Canada, and as such, was responsible for the bank's strategic planning, represented Canada and the bank overseas and at home in a series of discussions on policy, on regulation, on monetary, financial, and banking issues. When he retired, and I say retired in quotes, CIGI was thrilled to have him join us as a Distinguished Fellow, where he is the lead on our program in international finance. Paul has his undergraduate degree from the University of Western Ontario and then did his graduate work at the London School of Economics and at Princeton University. So he's eminently qualified, has published extensively on the subject, has also affiliations with Carleton University and C.D. Howe Institute, but today he is wearing his CIGI hat, among others, but to help us unravel this crisis. So welcome, Paul, and thank you.
Well, thank you for those introductory remarks, Roy Hinton, and welcome to all of you here this evening. And indeed, it is an honor for me to be here tonight and to help launch CIGI's Global Policy Forum. And as Roy Hinton mentioned, we're hoping to turn this into a reasonably regular event and one that hopefully will involve discussion with you to help us, but hopefully of benefit to you as well. So what I'd like to do is offer some thoughts, some perspectives that'll take, let's say 20 minutes, because I really do want to leave time for questions, comments, and some discussion. And I apologize at the beginning. I'm fighting a bit of a cold here, but that's not going to slow me down. One of those in attendance here tonight asked me if I was going to be offering a view of roses and rainbows, and I said, I don't think so. And indeed, I think we're all well aware of the contours, risks, and vulnerabilities of the global economy. Global economic growth remains very tepid. And projections from virtually all organizations have been revised down recently. In the case of the United States, economic growth is modest at best, And of course, we're facing, as you well know, the so-called fiscal cliff starting in January 2013, which equates to a 4% withdrawal of GDP in terms of either spending cuts or tax increases if that's not addressed. The eurozone is basically in recession, and its crisis remains, in my view, acute. And domestic demand in key emerging market economies has been losing momentum. And in summarizing its latest World Economic Outlook, the IMF says the outlook has become more uncertain and risks of a serious global slowdown are alarmingly high. Now, we can also look at the situation in terms of what I call levels of activity. Unemployment rates, and as you well know, unemployment rates amongst youth around the world remains unacceptably high. And in terms of levels of activity, GDP, the eurozone is still operating well below the levels that it reached in 2008. And in the United States, it has just recently regained that lost output. And against this economic backdrop, we have yesterday's election results and the transition of power in China that's going to take place over the course of the next few days. So all in all, a very charged, a very challenging environment for all of us. Now, what I'd like to do tonight is to try to connect some of these dots by focusing on three areas. First of all, I'd like to talk a little bit about the legacies of the global financial crises, the legacies as I see them. I'd also like to talk a little bit about the future of the euro, or as I put it, getting from here to there. And third, the need for new economic thinking to tackle the complex issues facing the global economy. So let me turn then to the first issue, the issue of the legacies of the global financial crises. And there are three features of the global financial crisis that stand out for me. First, excessive credit growth and unsustainable debt levels have been at the heart of the global financial and eurozone crises. Second, the global financial crises and the ensuing Great Recession also demonstrated to me the fundamental interconnectedness of the global economy. And third, in many respects, intimately intertwined with these interdependencies and propagation of the crises was the abject failure of the global financial system to fulfill its most basic fiduciary responsibilities. And here I'm thinking about excessive leverage, certainly in the US subprime and European mortgage markets, financial innovation and the products that were designed to repackage and through that diversify risks, but in the end actually obscured the risks that were being taken on. Failures in assessment and management of risk at virtually every level, and I'm thinking here of loan originators, credit rating agencies, and financial institutions. And finally, lax financial sector regulation and supervision at both what I call the micro as well as the macro level. Now, these features of the global financial crises point to a legacy of debt and impaired balance sheets, which will take time to correct. And this is very consistent with the work done by Reinhardt and Rogoff in their book, This Time is Different, comparing today's financial crises with that of other modern financial crises. And in practical terms, this points to three areas in need of critical focus by policymakers and politicians. First of all, the need to use all available tools to resolve unsustainable debt levels. Second, strengthen the global financial system. And three, promote international policy cooperation and incorporating interdependencies and spillover effects into domestic policy thinking. Well, with that perspective, let me then turn to the future of the euro, getting from here to there, as I call it. Now, in thinking about the eurozone crises, I think there are two elements that are important to bear in mind. And both require, I believe, a particular way of thinking about them. The first is resolving the crises itself. This is what I call the thinking fast or the urgent part of the crises. And the question here is, what is the right policy mix that will promote growth, adjustment, and have broad public support? And the second issue is the longer-term issue of governance of the eurozone. And this is the thinking slow, or the visionary part, if you like. And the question here is, can the right governance structures be put in place so that the euro and the eurozone can function effectively in the future? So what about the first of these two, resolving the crises? Given the legacy of debt overhang, it is imperative, in my view, to restore the impaired balance sheets by setting debt levels on a sustainable track. And the policy question here is how best to do that. Now, we're all familiar with the formula that determines whether a situation is stable or unsustainable. And that is a function of four variables: growth, real interest rates, inflation, and the primary deficit to GDP ratio. Now, where has the focus been in Europe in terms of dealing with the crises, the resolution of the crises? The three areas that I believe you could characterize as having received the main focus are, first of all, austerity, second, liquidity provision, and third, structural reforms. So let me offer just a few observations on each of these. First of all, austerity. I'm clearly in the camp of those that believe austerity alone is not the answer to putting countries on a sustainable track. We're seeing depressed economic conditions throughout the eurozone, and indeed the latest projections show countries moving further away from target levels as a result of the implosion of their economies. And I know of no economic model that would generate a sustainable scenario given the degree of austerity that's taking place in some of these jurisdictions. Second, liquidity. Liquidity has been a very, very critical part of trying to deal with the crises in the euro area. And the ECB, the European Central Bank, has taken measures on several fronts to provide liquidity to help markets function effectively or more effectively, and provide liquidity in terms of helping to bring down risk premia in some of the spreads, particularly some of the spreads of the sovereigns. And earlier this year, we had the long-term loan program, and more recently, what's called the outright monetary transactions mechanism. And these have been important, without doubt. But I do believe at the same time there's been insufficient attention given to this distinction between those sovereigns that are solvent but illiquid and those that in fact are insolvent. And I think this has resulted in, as we call it, kicking the can down the road. And this almost certainly has increased the solvency risk of the eurozone overall. And third, on the structural side, yes, again, important areas to pursue and get the euro economies working more effectively. But we also need to bear in mind that these structural reforms do take time, and in the short run, and this is what we're really talking about here, the short run can depress demand and supply as resources get reallocated. So the question here is this the right policy mix? Or is there a better policy mix to promote growth, speed up adjustment, and have broad public support? Well, here's my list. I do believe that more debt restructuring is needed in Europe, certainly in the case of Greece, and quite possibly elsewhere, conditional on whether there is, in fact, a return to sustained growth or not in these other jurisdictions, Portugal clearly being an example. Second, continued liquidity provision is also very important, but only in the market for the debt of sovereigns who can indeed meet their obligations, i.e. those that are clearly viewed as being solvent. I also believe that more expansionary monetary policy is needed in the eurozone. And this beyond what has already been done, including the outright monetary transactions mechanism that was put in place recently. Now, on this OMT, there are a number of, I think, very interesting issues, but they're also very technical. So I'm just going to set those aside, but maybe that's something we can return to in the question and answer period. But my main point is I do think there is scope for more monetary policy stimulus. And linked to the earlier point about the projections and the projections really beginning to look more like some of these countries are in a vicious circle as opposed to a virtuous circle, I think there is a need for slowing the pace of fiscal consolidation. And linked to that, I do see as well a scope for additional infrastructure spending that is targeted, timely, and temporary. And finally on my list is the recapitalization of banks to help get credit flowing in the eurozone. And I see that as being more urgent than in fact seems to be taking place. So you can see, I believe more can and should be done to promote a more vigorous recovery and to help put the eurozone on a sustainable track. So let's then turn to the other part. This is the think slow part of my remarks. That is the governance issues or the governance structures needed in the eurozone as we go forward. And this is also going to take us a little bit down the path of Bob Mundell's original work on the theory of optimum currency areas. Now, a number of areas are being discussed, including ones where initiatives are in fact being taken, and in some areas where some of those initiatives have moved further along the track than others. And some of these initiatives, let me just list them: the issue of a banking union, the issue of a fiscal union, the issue of ex-ante risk sharing across the eurozone, a sovereign bailout fund, and market reforms of various types. So let me discuss each of these in turn. On the banking union side, this is something that I do believe is very, very important. I think it's needed to promote financial soundness with a single supervisory mechanism, for example. I think it's important to have an effective lender of last resort for financial institutions in the eurozone. I think it's important to break what I call the incestuous link between banks and sovereigns. And I also think it's important to facilitate the introduction of euro financial instruments. Now, this is an issue that has gotten both positive and negative commentary, but the way I see this issue is I do believe it would be beneficial to the monetary and financial stability role of the ECB. Now, on the fiscal union side, a fiscal union actually is not a prerequisite for a monetary union. We don't have one in Canada. There's not one in the United States. And indeed, it wasn't part of the original optimum currency arguments put forward by Bob Mundell in his groundbreaking work. But I would argue that it is important to have some degree of federal level responsibility, if for no other reason than to have, for example, the capacity to have automatic stabilizers work at a euro pan level to help support macroeconomic stability. In terms of ex-ante risk sharing, one of the issues that's being discussed is deposit insurance to offer a consistent level of protection. And this I see very much going hand in hand with the idea of a banking union. And this too is something that I think is important if we're going to put in governance structures that are going to be durable in the eurozone area. Now, in terms of a sovereign bailout fund, we have had the launch of what's called the European Stability Mechanism, which is there to support countries in financial difficulty that are deemed to be solvent. This is not an area of responsibility for the ECB. And again, this may be something we can get into in our question and answer period. And as I see it, links back to this outright monetary transmission mechanism in one particular way. But to complement this bailout fund, I also believe that there's a need for a debt restructuring regime for countries that indeed are not eligible for the ESM, i.e. they are deemed to be insolvent. And then finally, on the market reform side, issues like greater wage and price flexibility, mobility of factors of production and goods and services, I believe indeed are very important. So by and large, when you go down this list, you think about it, most of these initiatives are moving, or at least pointing, in the right direction, but some of them, in my view, are not. Now, is there anything useful here from the Canadian experience that we can draw out in terms of these governance issues for the eurozone going forward? Now, Canada is not a common currency area, but what makes it work, at least in part in my view, as a monetary union, are the economic policy frameworks that have been put in place in Canada, not without trial and error, and that do work in tandem. And these frameworks would include a national monetary policy with a clear remit and a central bank capacity to act as a lender of last resort to financial institutions. A federal fiscal authority that can help manage the macroeconomy and provide risk sharing, including through the use of automatic stabilizers, and in principle, each level of government assuming responsibility for management of its fiscal position. We also have a national banking regulator and a deposit insurance scheme. And we have mechanisms that bring these national agencies together to address financial stability issues. But here, in my view, there is some room for further improvement. And then finally, on the structural policy side, over time, we have promoted internal economic flexibility and mobility, which again helps enormously in terms of the efficiency, the functioning of the monetary union called Canada. But here too, I think much more can and should be done. So let me try to wrap all of this up so that we have time for questions and comments. And let me start with a few concluding comments with regard to the eurozone. The eurozone, as we know it today, faces a serious problem of what I call dynamic inconsistency. And what I mean by that is without the right policies in place to resolve the crises, the initiatives to put in place durable governance structures and institutions will never be completed. Governance reform will run out of steam because of the failure to generate sustained economic growth. Now, moving forward on both of these fronts, resolving the crises and putting in place governance structures that can be durable, moving forward convincingly on both these fronts will require, importantly, a shift of sovereignty from the nation states towards the center. And this, I think, is really where the challenge is, both in terms of political leadership and the willingness of citizens to endure a protracted period of subpar economic performance. And the overriding risk is that a system under which the political and the economic currency boundaries do not match will prove to be unsustainable. And finally, let's just take a step back and take a somewhat broader perspective as we look out onto the global economy. Collectively, we face a number of very, very complex issues that demand new thinking and new policy approaches. And these issues include reforming the global financial system and creating a solid footing for the financial sector to interact and support the real economy, not the other way around. Secondly, rebalancing the global economy by successfully integrating advancing countries into the global economic structure. And when you think about China and India, just those two countries representing over a quarter of the world's population, I truly do believe we're at a crossroads. There's also the issue of tackling rising inequality of income and access to employment opportunities, education and healthcare in both developing and the developed world. And there's the issue of addressing climate change and environmental destruction. And then finally, on my list, providing global goods through collective action and sound governance structures. Indeed, now, more than ever, I believe, how nation states fare in a globalized economy rests on having governance structures that do work. And for that to happen, we need to understand better than we do today how the global economy works. In other words, what truly does tie us together. So thank you very much.
Yes, and just very briefly then, thank you, Paul, for being the inaugural speaker at the new CIGI Global Policy Forum series here at the Rideau Club in Ottawa. If any of you happen to be carrying a $20 Canadian bill with you, then you are actually carrying around a bit of Paul Jenkins because that is his signature on the currency.
Quickly disappearing.
Very stable and excellent currency. But I hope also after tonight that you are also carrying some of Paul's expert and informed views in your thoughts about the global economy. Paul, you made good on your promise not to deliver roses and rainbows, but you did offer some very useful alternative policy prescriptions to address the European debt crisis, and more importantly, perhaps, concrete and practical advice for the overarching global governance solutions that we need to integrate our increasingly interdependent economies. So thank you for those excellent insights, and thank you to our distinguished audience for coming tonight.